Hi, and welcome to another episode of the Michael Yardney podcast. Now, here's a question for you. What sort of returns can you expect from your property investments over the next decade? Not over the next year and this new year, but what's likely over the next decade? Well, I'm pleased to have independent financial advisor Stuart Wemyss, founder of Pro Solution Private Clients, with me again, because he recently wrote an insightful blog analysing what we could expect as property investors over the next decade. So today we're going to discuss some of the key trends, some of the potential risks, and some of the opportunities ahead for property investors. So I believe whether you're an experienced investor or just wanting to take advantage of this new market now in 2024, this episode's packed with some insights that are data-driven, evidence-driven, because Stuart's going to go back over 40 years with historical data to help us get an idea of what's likely to happen over the next decade. So let's get on with the show.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment, and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect, and pass on your wealth through strategic property and wealth advice. Now, here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
Hi, Stuart.
Hey, Michael. Great to be back with you again.
Yes, well, it's the beginning of a new year, and it's not surprising that at this time of the year, all the so-called property experts are out giving their opinion on what's ahead for our property markets in 2024. Now, I know you're also jumped in the ring with some thoughts, but unlike many of the others, I like the fact that you're bringing the perspective of many decades of investment experience, and you're offering realistic expectations based on evidence and data. Look, we know how wrong some of the forecasts were only 12 months ago about what was happening last year in 2023, or even the year before, that, because a lot of forecasts are being made by people in, let's call them ivory towers, but you're on the ground with your team at Pro Solution Private Clients. You're a successful investor yourself, but you've also been around long enough to pick the patterns and see what's going on. So I'd like to ask you some questions about a recent blog you did at the end of last year and your Investopoly podcast that I love listening to every Wednesday, where you forecast property investment returns and what we could expect not over next year, that's just too hard, or this coming year, but really over the decade. So let's start with some historical context. Is that okay?
Yeah, absolutely. And I think it's a good time horizon to consider these things. I mean, it makes for good, fodder for news and even good conversation at the dinner table in terms of what will property do next year over the next 3 years or so.
The media loves that. They contact you and me about those things, but I don't like giving year forecasts.
Yeah,
12-month
and it's
forecasts.
interesting. It's interesting to it's almost like a good parlour game, just to sit there and forecast, can I pick it or anything like that. But the reality is that no one can really predict what asset classes will do in the short run. In fact, there's no one in the world who's developed a successful methodology in doing that consistently well. And so really all it is just a bit of noise, and we can throw in our predictions and so forth. And, we might end up being right. We might end up being wrong. And when you look at the big bank economists, they've got teams of economists trawling over lots of data, and they've been wildly incorrect. And there's been a huge longitudinal study that shows that the greater the expert, the less chance there is of them being right as well, and that predictions no more successful than a toss of a coin. So, there's a 50-50 kind of element involved. And so as investors, again, it might make for entertaining conversation, but it really doesn't help us, inform us, make investment decisions. And so what I like to do is write about things that are more longer term, because I think it has more application from making investment decisions. And so if I'm contemplating either holding, retaining, or making additional property investments in a market, then I'm more concerned about what returns could be over the next 10 plus years rather than the next 10 plus months. And so what I had a look at, I looked at sort of rolling 10-year returns since 1980. So that is looking at, if I bought property in 1982 and held it to 1992, 1983 to 1993, and just looked at that rolling 10-year return. And what it does is it smooths out sort of the cycles a little bit, and it helps inform us of what we might be able to expect, or at least what the market has delivered in the past. And the interesting...
So when you're talking about returns, and I'll leave a link in the show notes for the great chart you've got on your blog on Pro Solutions website, what I was going to say is, though, you combined capital growth and rental returns as a combined return.
Yeah, exactly right. And I looked at the median house value, both in terms of capital growth and rental income returns, and the average of Melbourne and Sydney. So I've looked at the two major capital cities in terms of determining this information. And over the past 40 years, the rolling decade return has averaged 9.7%, which consisted of 7.3% capital growth and 2.4% in terms of net rental income. And when I talked about net rental income, what I've done is taken the gross rental income and reduced it by about 30%. To account for property-related expenses. And in my experience, property-related expenses tend to be around about 30% of the gross rental income.
I'd agree.
So it's just an average, but it gives us a good indication. The minimum return over that period of time was just under 5%. And so that was the decade ending 1999. So that included the recession that we had to have, which you would remember, Michael.
Well.
Yeah.
You were too young, weren't you?
That was almost too young, but I still remember it, sadly. And the best return was 13.6% for the decade end in 92. So obviously we had a really strong period of economic growth towards the end of the 80s. And then obviously we hit that recession that we had to have. So I think it sets the scene a little bit in terms of this data, in terms of what we might expect as property investors in the future if we're looking at very long-term returns, so decade-plus returns.
Well, you also, in your chart and in your blog, mentioned that we had the last decade had below average returns. Why do you think that was?
Yeah, I think there's been a lot of things contributing to that, and people talk about sort of interest rates, population growth, all these sorts of things as elements that influence property price growth and property returns, and they do. But really probably the biggest influencer on property returns is money flows. So if money is cheap and easily available, you will typically find that property markets will do really well. So if everyone that had the inclination to go out and invest in property could do so, and that's going to drive a lot of demand, of course, and then typically you'll see particularly capital growth, but even rental incomes rise as well. Whereas if money is hard to get, so that is that from a credit policy perspective, banks aren't easily lending money, or it's expensive, so interest rates are high, that stems money flow. And so I think if we look over the last decade, it has been below average. So Sydney average return is about 6% and Melbourne's only 2%, for example. So well below average. And the reason for that, I think, mostly is around lending. So you had the crackdown of interest-only lending. Then you had, to some degree, which indirectly impacted, was Shorten's policies around negative gearing. And then now you've had, much higher interest rates, which push the benchmark interest rate higher, which reduces a borrowing capacity and so forth. And that's reflected in the numbers when you look at the new lending numbers, over the last, say, 5 to 7 years, they've been well below average as well. And so that reduces the amount of money that can come into the market and the number of property investors that are out there in terms of demand.
You broke down in your blog and in your charts rental growth and capital growth. And the last decade, we've actually had a period of below inflationary rental growth, other than the last year or so. What's led to this period of low rental growth?
It's interesting, isn't it? And it's funny because you read the headlines and you look at the last 12 months of growth in terms of rental growth, and, people are worried for renters, and rightly so. They're typically not in a financial position where they can afford to pay 20 or 30% more than what they did last year. But if you look from the investor's point of view, like you've alluded to, Michael, around the last 10 years, the rental growth has been quite subdued. And normally what you'd find, and certainly when you look at those rolling 10-year returns, what you find is markets do move in cycles, in that you'll go through a cycle of strong rental growth and then you'll go through a cycle of strong capital growth. And those two things won't happen at the same time. So, whereas rental growth, say between 2009 and 2017 was above average, whereas since 2017, it's really sort of come off a bit. And there's going to be different elements to that. I think the biggest element has been the low interest rates that have occurred in 2020 and 2021, when it was cheaper to own a property than rent one. And we saw a lot of owner-occupiers buy property during that period, and kind of rightly so. If I can borrow at less than 2%, it's very cheap. If I can get into the property market, get a foothold in that property market, typically that's a good investment decision to make, a good financial decision to make. So we have seen a lot of owner-occupiers and also then a lot of investors leave that market, and that's created some downward pressure on rental yields, unfortunately.
Well, I remember when I first started investing many years ago now, rental yields were much more like 7 and 8% for just normal residential properties. Today, it's closer to 3 and 5%. And when we had a chat last month, we broke that down a bit and explained a little bit about it. I remember also when we spoke last month, we reminded listeners not to expect long periods of capital growth at the same time as rising rents. But that's something that we were able to enjoy and experience in 2023. But I think that was because there was a real shortage of rental accommodation, which I guess was the function of not as many private landlords, people getting out of the market at a time when there was very strong increasing demand related to population growth.
Yes, that's right. And what we really need for a healthy market is you want equal, maybe not equal levels, but normal levels of demand from both owner-occupiers and investors. And again, as I've alluded to over the last few years, the market has been mainly dictated by or dominated by owner-occupiers. And investors have actually been exiting the market over that period of time rather than entering the market. And so what we need to do is to have a sort of normalised market is we need that to equalise again, and we need landlords and investors to come back into the market. But also we need that to solve this rental crisis, because the longer it persists for, the worse rental incomes will be, or more difficult rental incomes will be for renters. Great for investors, but not so great for renters. So really, to frame our expectations around what the returns will be over the next 10 years from the property market, that's the number one thing for us to think about, is how are we going to solve this rental crisis, and will that solution have a positive or negative impact for investors?
Now, I bet you there's some people listening saying, hey, right at the beginning, those guys said they're going to tell us what to expect for investment yields over the next decade, and we are going to get to that. But rather than plucking a figure out of the thin air, what you're doing is giving us the basis upon which you've made those decisions, those thoughts, those forecasts. So let's just keep going a little bit further, and then I am going to pin you down to give us some ideas of what you expect ahead. But we were talking about the concept that there aren't enough private landlords, and in Australia the system is such that about a third of Australians rent, and not necessarily because they're poor, often just because of the stage of their life they're in. They're rent investors, they've just got divorced, they've moved to a new state, we've got for job. We've got migrants coming in who are not going to buy straight away. They want to find their feet in the country. And in other countries, the accommodation is provided by governments or public housing. Here, the government can't even provide enough social housing. So in my mind, it is the job of our government to provide housing for the disenfranchised, and social housing and public housing, because some people just will never be able to, for their own health or other reasons, get onto the property ladder. But it's now been left to private landlords, people like you and me and our listeners and our clients, to own investment properties. So it's ordinary mum and dads, and I'm not saying that derogatively, because in fact most only own one property. 92% never get past their second investment property. So I think a really quick way of solving the rental crisis is to attract more private landlords. I know they're going to do build to rent. That's not going to shift the needle much. And that's going to not provide affordable accommodation. So how do we attract more landlords, Stuart?
Yeah, that's right, and Michael, and even people talk about increasing supply, as in building more houses. That will solve the rental crisis in some locations, where there's available land to construct, but not in all locations, of course, and not in most locations.
Not where people want to live.
Yeah, that's right.
Where most people want to live.
Exactly right. So the first thing I think we need to do is help the people that actually want to become landlords, that want to invest in property, but are locked out of the mortgage market. I mean, that's kind of the low-hanging fruit, and that's the easy bit to do. So I've got a couple of ideas around that. Firstly, we need to cap the benchmark interest rate. At the moment, the banks have to add 3% on the current variable interest rate and then measure borrowing capacity on a principal interest repayment period or basis over a 25-year period. That essentially means to go and borrow $1 million, the repayments are about $105,000 a year. So that someone needs to have that level of surplus cash flow to be able to qualify for $1 million investment loan. Now, few people are going to be able to do that. And so what I'm saying is I think we need to cap that interest rate, because when interest rates are 2 or 3%, fair enough, add a 3% buffer. That we're well below average. But when we feel like we're getting to the top of the interest rate cycle, which arguably if we're not already at it, we're very close to it, adding a 3% buffer is unnecessary. And even testing repayments on a principal interest basis might arguably be unnecessary as well. So that's the first change that needs to happen. The second change that needs to happen is giving investors some security around interest-only terms. Now, if I go back, let's say 10 or 15 years, there were a handful of lenders that would have 15-year interest-only terms. So that is, investors could go out and borrow and have the security that their repayments will be interest-only for at least the first 15 years of that loan. At the moment, it's 5 years, and it's very uncertain whether you can get a rollover after that 5-year interest-only term has ended, and that creates some risk around borrowing. Investment loans are different to home loans. At some point, we all want to own our own home with no debt, and that's fair enough. With investment properties, it can be different, and holding some level of debt, even into retirement, can be not only a safe thing to do, but it can be a prudent allocation of resources as well. So I think there's some really easy fixes, and not very politically sensitive either. Whereas if you start providing incentives to investors or grants or these sorts of things, they can be politically difficult. So making changes to borrowing capacity, I think, will probably do most of the heavy lifting. And if that doesn't, I've got some other ideas as well.
Well, we can talk about those, but I think investors are leaving the market partly because of borrowing issues, or they can't enter the market because of that. But they're also looking for a level of sense of security. They're not wanting the changes to land tax, to Airbnb tax, other proposed changes. In many ways, the state governments have been seeing property investors as an ATM and taxing them where they can. So I think that's another way that they can help more investors come in by saying, hey, we recognise you're providing a service and we'll help you provide a service that we can't afford to provide at the moment. But you said you had some other thoughts too, Stuart. What are they?
Yeah, so I wrote a piece in The Australian where I suggested that maybe the federal government could incentivise landlords to either not only remain in the market to stop the exodus, but also maybe invite some new landlords in as well. And it sort of touched on what you just mentioned, Michael, which is there's two things that many states around Australia have done, is that they've tightened tenancy laws, which has created an additional layer of cost and complexity and risk for landlords. And look, some of these changes were necessary and prudent and reasonable. And in some cases, they've gone over and above and, of course, they've kind of over-regulated in some areas. And the second thing is that, as you said, a lot of state governments have used property investors as an ATM. Of course, most states generate most of their tax income from the property market in both land tax and stamp duty. And so it's a really tempting cohort to tap on the shoulder to raise additional tax revenue dollars. And there's not much, and the state governments aren't going to change that behaviour, of course, particularly Victoria that's in a lot of debt. They kind of have to raise tax dollars. But the federal government makes a lot of money from capital gains tax. Sure, their negative gearing costs them about $1 billion a year, but they make 10 or 20 times that amount off capital gains tax. So just like us as property investors, we get some negative gearing benefits, but when we go and sell the property, we'll pay a lot of tax. The federal government is on the other end of that transaction. So what I was thinking was maybe the federal government could then provide some additional tax incentive to offset the impact of the higher cost and higher taxes that we pay to our state governments. And so an example of that was maybe adding an additional capital gains tax discount for landlords that have their property available for rent for a period of 10 consecutive years. So again, to try and attract long-term landlords into the property market. And we know that if we own an asset and hold it for more than 12 months, sell that asset and make a gain, we all can apply a 50%, the general 50% CGT discount. And so maybe for landlords that had that property available for rent, maybe we could increase that discount to 60 or 65%, for instance, to really provide that kind of additional incentive. The other one I thought of, there's two others that I thought of. If you sell a small business and in some situations what you can, and you make a capital gain, in some situations you can roll that capital gain into your super fund or into your super account to avoid paying capital gains tax. And that was because that policy was put in place by the Howard government many years ago because they recognised that many small business owners didn't contribute to super, particularly 20 years ago, and that was their nest egg. Well, it's similar for property investors, right? They're investing to complement whatever super monies that they've got. One concession could be allowing property investors to roll some of that capital gain, if not all of it, into super to avoid paying capital gains tax. And another easy one is a few years ago, they said that anyone that was a non-resident, even though I was an Australian citizen, but they were a non-tax resident of Australia, and they held property in Australia, couldn't access the 50% discount. So that is people, expats, working overseas, going to London or whatever. There's a disincentive for them to invest in Australian property because they don't get the 50% capital.
Very big disincentive.
Very big disincentive. So they could remove that. They could reinstate that discount, particularly for Australian citizens, of course. One of the reasons that Australians go overseas, I mean, there's many reasons, but one of them is some career advancements and an ability to earn income. And having an incentive for them to invest in Australian property, I think, makes sense and will alleviate the rental crisis as well. So I think they need to change borrowing capacity first, see how that works. If that isn't enough to incentivise more landlords back into the market, then there's a few things they could play around with tax-wise to maybe achieve that aim.
Well, thank you. I think there's some great suggestions. I don't think the politicians are going to pay any attention to you, Stuart, despite you being written up in The Australian, but you did create some thought-provoking commentary from that, so that's great. So let's put it all together. Now that we've got the context of what's happened over the last 4 decades, how things have changed, where we are now in a period where we've got a lot of uncertainty, but I think that's going to remain with us. What are your long-term, not next year's forecast or this year's forecast, what are your long-term forecasts for rental growth and capital growth over the next decade?
I think it really depends on how long it takes the government to come around to solving this rental crisis. And that's not going to be an overnight fix, by the way. Even if they made some of these changes, it'll still take 12 or more months to really head off these rental hikes or rental increases. So, I think you can draw a circle around 1 to 4 years. Maybe it might take them that long to sort of solve it. So I think property investors will probably experience higher than average growth in income over that period of time. And as a result, because of lower demand from landlords, from property investors, capital growth is likely to be below average for that period of time. But once they solve the rental crisis, by definition, it means that more investors are entering the market. And that will create more demand for established property, and that will push prices ahead. So if I look at the next decade ahead, I think the first few years, let's say 2, 3, 4 years, will be most of our return will come in terms of income, more income than usual, maybe less capital growth than usual. And the remaining period of that 10-year decade will flip around. Income will probably remain steady, and we'll start to see a lot more capital growth. And if you have a look at the last 10 years, because it gives us a bit of context, we know that there's a strong trend of mean reversion in all markets, which means that a period of below average returns is typically followed by a period of above average returns. And given the last 10 years in terms of total return was below average, it's likely then that the next 10-year period will be above average returns. So I can see the capital growth at the second half of this next decade is probably going to be pretty strong, I would expect, all things being equal, but maybe it won't kick off just yet. We really need those investors to return to the market.
Well, capital growth occurs because of investors, but also homeowners. But there are a lot of factors involved, and we can't have double-digit capital growth again this year in 2024 as we had in 2023. The cycle would stop very quickly. It would be very short if we had that sort of growth. There's going to be headwinds this year. Interest rates are going to probably remain a bit higher, a bit longer than some expected. Inflation is going to take a little bit longer to get under control. If the government has its way, unemployment's going to creep up a bit. And we're really starting a new year with a level of uncertainty about what's happening with the economy, what's happening with the overseas issues. Consumer confidence is on the low side, and people don't make big buying decisions, whether it's their home or investments, when consumer confidence is low. On the other hand, I don't want to make any short-term predictions, but I think the end of this year, many markets will be higher than they were at the beginning of the year, but nothing like the growth we experienced in 2023. And that's really going to be based on the fact that we just haven't got enough supply for the homeowners or the owner-occupiers or the investors. So it'll be an interesting year, and once a month we're going to get together and keep talking, but I'm going to suggest that anyone who's enjoyed the insights you've brought to subscribe to your Investopoly podcast and go to the Pro Solution website, and I'm going to leave a link to that in the show notes, where every week on a Wednesday you come out with some clever thoughts and also your podcast. But talk about Pro Solution and your website. Maybe you could explain what services you provide for property investors.
Michael, most financial decisions are multifaceted, and property investing is a great example of that. If we're investing in property, we're thinking about cash flow, wealth accumulation, how does it interact in my long-term strategy with super, borrowing capacity, taxation, of course, which we've sort of touched on. And so we've built a multifaceted team that'll sit around and workshop ideas for our clients, so that the responsibility isn't sitting on our client's shoulder to work out what information is important to tell which advisor. And that gives us the greater scope to add value to our clients to help them really achieve their financial goals. So as you said, probably the best thing for people to do if they want to learn more is to seek out that podcast, learn a little bit more about the way we think, and if that resonates, of course, they can make contact.
Fantastic. Well, I'll leave a link to all of those in the show notes, and look forward to catching up with you again in a month's time, Stuart.
Thanks, Michael. It's been great as always.
I hope you enjoyed my chat with Stuart Wemyss, and if you did, and you don't currently subscribe to this podcast or follow this podcast, before we get on to the next couple of segments, just stop for a sec and go to whichever podcast app you're listening to this on and follow this show, so twice a week you get the information that my guests and I have to share with you. And I've also got a link in the show notes for a special bonus for you, just as my way of saying thank you for listening to my podcast. Go to podcastbonus.com.au, and there's a heap of reports and ebooks to help you become a better property investor. Now, with 2024 bringing a different housing market to 2023, are you ready? Are you prepared? If you think about it, last year in 2023, we had significant, strong property growth month after month, double-digit growth in a lot of markets and skyrocketing rents. But 2024 is going to be different. I still think we're going to have strong property markets, but they'll be more fragmented, more segmented, and not any property is going to make a good investment. And similarly, not all homes are going to grow in value the same. So even if you're looking to buy a home, my suggestion is you put your investment cap on unless it's your forever home. And I know that when we look back in 12 months' time, there's going to be some people who've taken advantage of the opportunities over the year when the markets will again rise, and some people are going to do very well. But there's going to be a whole lot of people who are just going to have sat on the sidelines, just waiting for the message to get clearer. And there's going to be others who unfortunately will have to get out of the market because they've made the wrong decisions. The next few years are going to be very, very different years in property. And if you're a property investor, you may have to change the way you think about property or change your strategy to cope in the new environment. So let me help you. Why not turn to the multi-award winning team at Metropole for independent, unbiased property and wealth advice? By the way, we're much, much more than just another buyer's agent. We help our clients safely grow into generational wealth through property, but we have wealth advisory and property development, renovations and property management. But even all our property advice is based on strategic evidence-based property plans that we put together for our clients. We're big enough to tip the scales in your favour, but still small enough to care. So whether you're just getting started or want to grow your existing property portfolio, I hope our team can help you. Let's have a quick chat, and if we can't, we'll definitely tell you, but go to metropole.com.au, and I'd love to be part of your ongoing wealth creation journey.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In today's mindset message, I'd like to talk to you a bit about worries. In fact, the evolution of worrying and how in the past it may have been protective, but why today it may not be as useful as that. Think about it. Thousands of years ago, it was part of what kept humans alive. Is that a lion in the bush? Was it that tiger? 9 out of 10 times, there probably was no large saber-toothed animal out there to pounce, but worrying saved lives. Often this then became ingrained. But fast forward to the present day, you're probably listening to this on your smartphone, and you probably don't have to worry about things that our ancestors did. But I bet that doesn't stop you from worrying, does it? Today, instead of being hyper-vigilant about big scary predators that could actually kill us, we obsess about the economy, the property markets, our job security, the value of our homes, or other sources of possible inconvenience. But there are two problems with this. Firstly, most of the things we worry about just don't happen. And secondly, even if they do happen, worrying doesn't really help, does it? Today, rather than keep us alive, our worries are more like spinning on a wheel in a ditch. They tend to be pointless, ineffective, and often border, for some people at least, on compulsive and neurotic. So my recommendation to you today is to get out of your worry rut, but this takes practice and this takes determination. So next time you feel stuck in a rut of worries, try asking yourself these simple questions. Firstly, ask yourself, what's the worst thing that can happen? If death, dismemberment, or complete financial collapse is actually occurring to you right now, well, okay, you're allowed to keep worrying. If not, just get back to work. The second question to ask yourself is, when I worried about this in the past, did it actually help? If you think about it, worrying about things almost never helps. If it isn't helping, then why worry? Why keep doing it? And the third question to ask yourself is this a now problem or a then problem? How often have you created a problem of mythical proportions? Oh, look, I've lost my iPhone. Somebody's stolen it. I'm going to become a victim of identity theft. Only to discover that in reality it wasn't a problem at all. Oh, look, there it is. It's left inside my car. So don't confuse then with now. Think of all the mental energy we can free up for our family, for creative pursuits, for even earning a bit more money on the side if we stop worrying incessantly, if we stop worrying unnecessarily. Now, I'm not saying never worry. I'm just gently suggesting not to get stuck in the rut of continuously worrying. Try and keep your worrying in a healthy groove instead. Well, thanks for spending the last little while with me, and I hope you got some benefit from this show. If you did, and you know somebody else who'd also benefit, please tell them about the Michael Yardney podcast. There's a share button on every podcast app. On Apple Podcasts, there's 3 little buttons down the bottom. Press it and share it, or just tell them about the Michael Yardney podcast. I hope you're going to be doing them a favour, and you'll definitely be doing me a favour and helping me in my quest to make as many people as possible financially literate. Now, there's ways of catching up with me between these shows. Just look for Michael Yardney on social media, or why not join my private Facebook group? Go to Facebook and look for the Property Update Facebook group. And I have a way of saying thank you to you for subscribing to this podcast. Go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where you can get a bunch of ebooks and reports. My way of saying thank you. And when you've got time, why not listen to some of the old podcasts? There's individual lessons in each of those that I think would be helpful for you. I'll be back again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney Podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?